Palantir just posted a Rule of 40 score of 114. If that number means nothing to you, stick around for about 90 seconds because what I'm about to explain will change how you evaluate every single software company from now on. Look, if you're the type who clicks away after 30 seconds or simply finds my voice annoying, here's what you need to know. Palantir's US commercial business grew 121% year over year. That's not a typo. And the stock dropped 4% after hours anyway. The market's telling you something, and it's not what you think. Now, whether you stay or go, that's the takeaway. But if you've got 10 minutes, I'll show you exactly what's happening both fundamentally and technically. Hey, I'm DataCat. So for those of you who are new here, welcome. This channel's only about 3 months old, so we're all kind of figuring this out together. A bit about me. I spent years as an analyst inside a Fortune 50 company. Messy data, meetings about meetings, technical debts, the whole corporate circus. I eventually traded that fluorescent lit nightmare for, well, lasers and keyboards. A bit better for my mental health, honestly. Now, I'm not here to brag or anything, I don't do the whole guru thing. But I spent enough time inside the corporate machine to recognize when something genuinely unusual is happening. And what I'm seeing with Palantir right now, it's really something. Also, yes, DataCat. Because cats are efficient, we don't waste time on nonsense, and we're surprisingly good at knocking things off tables when they don't make sense, which is exactly what I'm about to do with the conventional wisdom around this stock. But before we move on, hitting that like and subscribe button would help a lot. It keeps me motivated and avoids my cat's judging silence whenever I talk to the screen. So let's talk about Palantir's Q3 earnings, because these numbers are either the beginning of something historic or we're all about to learn a very expensive lesson. Alright, so Palantir reported revenue of $1.18 billion. That's up 63% year over year. Already, that's exceptional for a company at this scale. But here's where things get weird. I mean, really weird. Their US commercial revenue specifically hit $397 million. That's up over 120% year over year and 29% from just last quarter. Quarter over quarter growth like that doesn't happen in enterprise software. It just doesn't. Now, before I go further, let me explain something for those of you who don't live and breathe SaaS metrics. There's this thing called the Rule of 40. It's pretty simple math. You take a company's revenue growth rate, add it to their profit margin, and if the result is above 40, you've got a healthy business. Above 60, excellent. Above 80, rare. But Palantir just hit 114. Let that settle in. 114. Most enterprise software companies at Palantir's size can't sustain at 80. They're pulling off over 100, and they increased it by 20 points from last quarter. So naturally, the stock dropped 4% after hours, because, you know, the market's rational. Sure, now you might be thinking, okay, DataCat, big numbers, cool. But what does this actually mean? And that's the right question, because top-line growth is one thing. How they're achieving it, that's the story nobody's talking about. So here's what's happening under the hood. Most enterprise software companies operate like this. Massive sales teams, bloated contracts, mediocre products, and a lot of steak dinners. And yes, I was kind of part of it. You're essentially paying for a sales process, not software. The product itself, commodity, interchangeable, boring most of the time. Palantir's doing the opposite. Their sales team is shrinking while revenue's exploding. How? Because they're not selling software. They're solving problems that CEOs lose sleep over. Let me give you a real example from the earnings call. A medical device manufacturer started with a single use case. 5 months later, they expanded their contract 8 times, not 8%. And the CEO was personally involved. In traditional enterprise software, the CEO shows up for the initial handshake and maybe the renewal. That's it. But with Palantir, you're seeing C-suite executives reorganizing their entire companies around the platform. And one of their executives puts it perfectly. The conversation evolved from a single use case to pursuing the opportunity of becoming an AI-first enterprise. That's not a simple product sale, that's a transformation. And here's the part that should make you sit up. Palantir just announced their total contract value bookings hit $2.8 billion. That's up 151% year over year. To put that in perspective, they've locked in about 2 years' worth of current revenue in backlog. Oh, and the deal velocity? 204 deals over $1 million, 91 deals over $5 million, 53 deals over $10 million. These aren't pilot projects, these are company-wide deployments. Now I know what you're thinking. This sounds too good to be true. And you know what? You're right to be skeptical. Cats don't trust easily either. We knock the glass off the table first, watch it shatter, and then maybe we believe you. So let's talk about what could go wrong. First, customer concentration. If a handful of mega customers are driving most of this growth, any churn becomes catastrophic. We don't have perfect visibility into this, but it's worth watching. Second, Europe is dead weight. Their international commercial business only grew 10% year over year. Alex Karp was visibly frustrated during the call. Europe's regulatory environment, data localization requirements, the whole bureaucratic mess, it's strangling growth. And that's 30% of global GDP they're essentially locked out of. Third, political risk. Palantir's positioning is controversial. They work with governments, military, intelligence. That wins them massive contracts, sure. But it also makes them a target. One bad headline, one scandal, and you could see institutional investors bail. And finally, sustainability. These numbers are so good that even I'm sitting here going, can this continue? Alex Karp himself said these might be the best results any software company has ever delivered. That's not hype. That's him genuinely wondering if they've peaked. So when the stock dropped 4% after hours, it wasn't irrational panic, it was the market asking, okay, but what's Act 2? Now let's talk about charts for a minute to get a better picture. Before earnings, Palantir's RSI was sitting at 71. The stock was trading over 10% above its 20-day moving average and almost 18% above its 50-day. It was at the 99th percentile of its 52-week range. Literally, 99.8%. It had nowhere to go but down. So the post-earnings drop? That was telegraphed. The market was already screaming, pullback incoming, before the numbers even dropped. Now, not financial advice. Remember, I'm just a random guy on YouTube, but if I were entering fresh or, adding to a position, here's my playbook. I'm watching $188. That's the first real support level. Given its high volatility nature, there's a good chance we'd hit that within 2 weeks. If it drops there, I'm watching volume. If selling dries up, that's accumulation. That's your entry. If it falls to around 175 to 178, that's the 50-day moving average. That's the no-brainer zone. You set your stop at 169 and you take the trade. And if somehow we get a macro event and this thing crashes to 165, that's the tell your grandkids entry. I'd personally think it's a rare event, but if it happens, I'd back up the truck. On the flip side, if it just rips higher and never pulls back, don't chase above 210. FOMO is the enemy. Wait for the next earnings and get another shot. So look, here's my take. Palantir's business fundamentals are absurd. 121% growth in US commercial. Rule of 40 at 114. 2.8 billion in backlog. These are numbers that don't exist in nature, but the stock's extended. The valuation's priced in a lot of perfection. And Europe's a drag. So the market's doing what it should. Taking profits and reassessing. Does that mean Palantir's a bad investment? No. It means the easy money's been made. From here, you need conviction, patience, and a plan. Me, I'm watching 188. If we get there, I'm interested. If we get to 175, I'm very interested. And if we somehow crash to 165, I'm selling furniture to buy shares. But I'm not chasing. Cats don't chase. We wait, we watch, and we pounce when the moment's right. Anyway, that's it from me. If you found this useful, subscribe, I guess. Like I said, we're only 3 months in, so every bit helps. And if you didn't find it useful, well, you're still here, so maybe you did. Thanks for watching, and remember, the market doesn't reward hype, it rewards patience. DataCat out, I'll see you in the next one.